Well, distinguished guests, colleagues, ladies and gentlemen, welcome to the 2017 annual Peston Lecture, when we celebrate the contributions made by Maurice Lord Peston, founder of the Department of Economics here at Queen Mary University of London. And I'm delighted that Lord Peston and indeed other members of the Peston family are able to join us once again. In 2016, the now School of Economics and Finance here at Queen Mary celebrates its 50th anniversary. And there is indeed much to celebrate in terms of the contributions from the school in both teaching and research. For example, the 2015 National Student Survey ranked the school as the leading economics school in London. The 2014 Research Excellence Framework placed the school in the top 10 in the UK with respect to research power, making a strong contribution to the overall very strong performance by Queen Mary University of London. The Peston Lecture embodies the School of Economics and Finance's commitment, both in teaching and research, indeed reflecting Lord Peston's values, in using economics to inform public policy through both research and teaching. We're delighted that this year's lecture is to be presented by Mark Carney. Mr. Carney is a Canadian, educated at Harvard and Oxford. After a 13-year career with Goldman Sachs, he served as Deputy Governor of the Bank of Canada in August 2003, and then became the Senior Associate Deputy Minister of Finance in Canada in November 2004. He was appointed Governor of the Bank of Canada in February 2008, and served in this role and as Chairman of the Board of Directors of the bank until June 2013. His appointment as Governor of the Bank of England was announced in late 2012, and he took up his post in July 2013, and in the process accumulated various other roles, both within the UK and well beyond. He is the first non-Briton to be appointed to the role since the establishment of the Bank of England in 1694. Governor Carney, welcome to Queen Mary. May I invite you now to present the 2017 Peston Lecture. Thank you, Simon.
Thank you very much, Simon. It's a great pleasure to be here at Queen Mary University of London to give this. Now I have it as the 2016 Peston Lecture, and of course, a lot of this is about timing and dates of various policy decisions. So I think I'll stick with 2016 for the moment. And it's a particular honor, and when Colette Bow extended your invitation to me, was very keen to come here and fulfill that invitation because of the opportunity to honor the 50th anniversary of the founding of economics here at Queen Mary. And it is a great honor that Lord Peston, Lord Peston straight ahead of me, and his family are here to hear this lecture. You'll judge whether it actually does honor you in about 45 minutes when I finish my dirge. Having anniversaries are an opportunity to both look back and to plan ahead. And when doing that, it's sometimes helpful to recall Shimon Peres's definition of a young person as someone whose future ambitions exceed their past accomplishments. And so when I think about, and we were talking earlier about an economics faculty that was founded in a dog biscuit foundry just up the road 50 years ago, and I think of all the development that's happened since then, certainly the past accomplishments are legion. But I know Sujoy and his colleagues in the current economics faculty have great ambitions for further progress. And more broadly, Queen Mary can take justified pride in its long-standing commitment to community engagement, to local participation. But really what's most striking, to me at least, are your plans for the future, and there are many, but including broader research into areas such as population-scale genomics and research that has the prospect of providing benefits across the United Kingdom and far beyond. So Queen Mary is clearly a young institution. And I can say on a personal level, 50 is a young age, just establish that. Anniversaries are a time for reflection. The turn of the year is also a time for reflection and for planning. The start of 2016 in the UK marked the turning of a page in banking regulation and a turn in our financial conditions. And at the same time, it did not yet herald a turn in the stance of monetary policy. And so what I'd like to do today is to expand on these developments, including what they mean for the UK's economic prospects. Take a step back at the start, though, to say that since the bank's full powers came into force a few years ago, we have pursued a strategy at the Bank of England to rebuild the resilience of the banking system, to maintain an accommodative stance of monetary policy in order to achieve the inflation target, and in the context of that, support the economic recovery. And we've also worked to develop and deploy a new macroprudential toolkit to prevent the emergence of vulnerabilities that could ultimately derail that recovery. I think we've made determined progress. In particular, we've reached inflection points in micro and macroprudential policy, and we're able to set out some of the requirements for one in monetary policy. And in doing all of that, I think we've increased the prospects for a durable expansion. But as my colleague Martin Wheel, who's here today, and thank you for coming, Martin, as he knows well, the path of policy is not preordained, and continued progress in all these respects will take vigilance and dexterity. And that's because private and public balance sheets remain stretched, the global environment is unforgiving, and the supply side of this economy is still healing. And I'd like to expand on those points. I'd like to begin with our financial system, the foundation on which strong, sustainable, and balanced growth is built. The combination of a radical overhaul in the regulatory framework and years of determined efforts have significantly strengthened the UK banking system. And consequently, last month, the Financial Policy Committee of the Bank of England was able to send two signals that the system had turned the corner. First, the FPC clarified that the capital framework for banks, it clarified that capital framework, I should say, and in doing so, it provided much-needed certainty for those banks and for their investors. And second, the FPC has made a judgment, it now judges, that the system is already within sight of the level of capital it needs by the end of the decade. It is already almost there. And moreover, that the banking system here has the capacity to lend and continue to lend to the real economy, even under severe stress. The Bank of England's most recent stress test underscores these improvements. And it was a test that we conducted last year, which centered on a sharp slowing of Chinese growth, a slowing which prompts a big reassessment of global economic prospects, dramatic falls in the prices of financial assets and commodity prices, and increased global deflationary pressures. You may think that sounds familiar. We found that even in the face of such stresses, even in the face of such challenging conditions abroad, the UK financial system can continue to take the types of prudent risks that are necessary to grow jobs and incomes here. In short, the efforts of the banks over the past 7 years to rebuild their balance sheets and improve risk management are beginning to pay off. Mortgage rates are at all-time lows. Corporate credit availability has recovered, and lending to small firms is growing again for the first time since the crisis. These improvements in price and availability of credit are signs of normalization of the UK's financial environment. Other signs include that after 7 years of deleveraging, credit to the UK private sector is growing again in aggregate. Now, to be clear, this has not been a debt-fueled recovery. Private credit growth is modest compared to pre-crisis rates, and it's just now coming back in line with nominal GDP. But that said, vigilance is merited given the softness in that nominal GDP growth, the still elevated levels of household debt relative to income, the UK's large current account deficit, and pockets of more buoyant activity in areas such as buy-to-let mortgages, unsecured consumer credit, and commercial real estate. More fundamentally, it doesn't take a genius to recognize that a prolonged periods of low and relatively predictable interest rates could encourage the buildup of excessive risks. And that's why the bank is monitoring risk closely and has taken action where appropriate. Those actions include introducing limits on high loan-to-income mortgages, having requirements for banks to assess whether borrowers could still afford those mortgages at much higher levels of bank rate, and conducting an ongoing review of underwriting standards in the buy-to-let sector. In addition, the FPC of the bank has made clear that it intends to set the countercyclical capital buffer above zero before the level of risk becomes elevated. It's because of such active macroprudential policy that monetary policy can focus on its primary job of inflation control, and it's to that which I'll now turn. Well, an obvious question is, if the turn of the year heralded normalization of bank regulation and macroprudential policy, why not the start alongside of the normalization of monetary policy? After all, the Federal Reserve raised rates in December, and some might ask whether the special relationship extended to matters monetary. Now, to my mind, there are currently some important differences across the Atlantic. First, cost pressures in the US are growing above historical averages, while in the UK they're rising at a speed notably below that consistent with the inflation target. Second, the UK economy is twice as open as the US economy, and it's therefore more exposed to global weakness and the drag that it imparts on exports. Third, this greater global exposure also means that pass-through of weak global inflation, compounded by sterling's past depreciation, is likely to exert a greater and more persistent drag on UK inflation. And fourth, the stance of fiscal policy differs markedly. The UK is undergoing the largest fiscal consolidation in the OECD. In contrast, US fiscal policy is expected to loosen notably over the next 3 years. And finally, that control over macroprudential policy that I spoke about a moment ago that the Bank of England has is not the case in the United States. And that control reduces the need for us to use monetary policy to address financial stability considerations. I think we should also recall that the December move by the Fed, despite an expansion that began 2 years before that in the United Kingdom, the Fed only raised rates to our lofty level of 0.5%. And that's not a facetious point. I'm not trying to be facetious here. As my colleague Jan Valega on the MPC argued yesterday in a speech, there are a variety of structural factors that have likely depressed the so-called equilibrium interest rate, or said another way, the rate consistent with the economy operating at full employment and inflation at target. And this is consistent with my long-held view that rate rises, when they come, are likely to proceed at a gradual pace and to a limited extent. Most economics is at the margin, and the tightening of monetary policy, once warranted, is likely to be marginal for some time. Now, given all of that background, what are the prospects for a rate rise in the United Kingdom? Well, last summer, I said that the decision as to when to start raising interest rates would likely come into sharper relief around the turn of this year. Well, the year has turned, and that decision proves straightforward. Now is not yet the time to raise interest rates. This wasn't a surprise to market participants or to the broader public. They observed the renewed collapse in oil prices, the volatility in China, the moderation in growth and wages here in the UK, and rightly concluded that not enough cumulative progress had been made to warrant tightening monetary policy. Looking ahead, the outlook for monetary policy depends on three things: the MPC's objectives, its strategy, and obviously the UK's economic prospects. The MPC has made our objective clear. It's to return inflation to target in a way that avoids undue volatility in output and employment. Our strategy for achieving the inflation target varies over time, and it depends on the nature of shocks that are hitting our economy and the risks that our economy is facing. At present, the MPC is seeking to return inflation to target in around 2 years and to keep it there in the absence of further shocks. In other words, we don't want an overshoot of inflation. This 2-year time horizon reflects the need to balance the strength of private domestic demand against the sustained headwinds from ongoing fiscal consolidation and a weak world economy. External factors, including the strong exchange rate and subdued global price pressures, can be expected to exert a persistent drag on UK inflation. And in order to offset this drag, domestically generated inflation pressures must rise. But this process must be sustainable. That is, it shouldn't come at the expense of future excessive volatility in either output or employment. The MPC's current policy horizon of around 2 years reflects our judgment on how to best balance these persistent forces, while implying a slightly tighter stance of monetary policy, all else equal. And since monetary policy operates with a lag, it must be forward-looking. In other words, monetary policy will continue to depend on our economic prospects, not the calendar. These prospects must be assessed in the light of an unusually uncertain supply side of the economy. The financial crisis upended the certainties of the pre-crisis era, when productivity progressed rather predictably and labor supply expanded at a steady pace. As we all know, productivity growth fell markedly after the crash, and though it's been picking up recently, now seems to be oscillating around a trend somewhat below its historical average. There have been sharp increases in labor supply caused by the need of people to work to help pay down past debts and also to rebuild retirement incomes. And more recently, net migration has been higher. And many of these shifts on the supply side, are still playing out. To make forward-looking policy today in light of such uncertainties about tomorrow, we're tracking a broad range of indicators. These are indicators that not just help to give a picture of how the economy is evolving in real time, but also to help us update in a Bayesian fashion our assessment of the prospects ahead. In this manner, being data-driven isn't akin to looking in the rearview mirror, but it's more like adjusting our speed to the terrain ahead. And although different indicators will merit different focus at different times, as I highlighted last summer, in my opinion, 3 warrant particular attention at present. The first is the prospects for growth, momentum, and slack. The second is evidence of a sustainable firming in domestic cost pressures. And the third is developments in core inflation, developments that are consistent with a reasonable expectation that total CPI inflation will return to target in around 2 years' time. Progress in all 3, both realized and prospective, will increase confidence that the initiation of limited and gradual rate increases will be consistent with returning inflation sustainably to target. So in light of that, let me turn to some of those recent developments, and I'll start with momentum and slack. After gaining momentum in 2013 and peaking around 3% in 2014, output growth has been steady during 2015 at rates close to 2% or a little below pre-crisis averages. The average quarterly growth rate during 2015 of around 0.5% has disappointed somewhat compared to our summer expectations of 0.7%. And the shortfall appears to reflect much weaker net trade, the absence of a rebound in housing activity, and less robust than expected consumption growth. Nonetheless, private domestic demand is still solid, and household consumption has been resilient. That household consumption has been underpinned by the strongest real income growth since the crisis and the highest levels of consumer confidence in a decade. Surveys suggest that investment intentions of businesses remain robust, and it seems reasonable, on the whole, to expect such solid private domestic demand growth to continue. Now, that cannot be said of the global economy, which has slowed even relative to the MPC's modest expectations in the summer. There are a few positives. The broadening of euro area growth has offset the effects of moderation in U.S. growth on UK-weighted demand. And to the extent that the renewed sharp declines in oil prices are predominantly supply-driven, they should support growth, though sustained spillovers to tightening financial conditions would mean to a lesser degree than usual. But clearly since August, downside risks to growth in emerging markets have begun to crystallize. And this has triggered sharp falls in risky asset prices, rises in risk premia, and falls in the expected path for policy rates across the advanced economies, including for the UK. And further downside risks to global growth remain, reflecting mainly the ongoing challenges in China, fragilities in other major emerging market economies, and the potential for financial contagion. As one consideration in setting monetary policy, given this demand outlook, we have to evaluate how much of the recent moderation in output growth reflects slower supply growth. We can take a simple read from the unemployment rate, which has continued its solid downward trend since the autumn of 2013 and has fallen more rapidly than we had expected in August. We have short-term unemployment in this country now below its pre-crisis average, and the vacancy to unemployment ratio, a simple measure of labor market tightness, is at its highest observed level since August of 2005. Now, in the immediate aftermath of the crisis, one reason why the headline unemployment hasn't been a sufficient statistic to measure tightness in the labor market has been because of underemployment of those in work. Since the start of 2013, the gap between actual and desired hours of workers has been closing, though, and most recently it has been closing rather sharply. We think this may reflect a normalization of working patterns, with desired average hours returning to their pre-crisis level rather than an unwelcome decline in labor demand. An additional source of labor supply is net migration, which recently has been running above past averages. However, we should remember that the implications of this for inflation are likely to be relatively small, as migrants not only supply labor, increasing supply in the economy, obviously, but they also spend their incomes, increasing demand in parallel. On balance, my read is that these labor market indicators point to a further normalization of the labor market, and that they're broadly consistent with the MPC's expectations last summer for a modest decline in slack across the economy. So given that, what could these mean for cost pressures? As the economy has continued to expand and slack diminishes, the resulting pressures on resources would be expected to bid up wages, all else equal. However, recently, despite falling unemployment, wage growth has moderated from around 3.25% to around 2.5%. This could reflect a range of influences which have varying relevance for the inflation outlook. Those influences include the composition of new jobs, the normalization of working patterns, which I just discussed, and the possibility that the rate of unemployment at which the economy can operate without accelerating inflation, the possibility that that rate of unemployment is lower than we previously thought. But there's one other possibility I want to raise, which is that the moderation in wage growth reflects the low headline inflation rate itself. With widespread recognition that there's literally no inflation at present, bargaining over real wages is more straightforward. Indeed, there is some anecdotal evidence from our bank's agents that slower increases in household living costs have been a significant driver of lower pay awards. If this isn't occurring, it will obviously slow the buildup of cost pressures, and it bears watching. We at the MPC will remain vigilant for signs that low inflation is having second-round effects in the wage bargain, possibly via inflation expectations. Now, as a base case, the mechanical return to higher rates of inflation as past falls in energy prices drop from the annual comparison, that should in time reverse this effect and support wage gains. And more fundamentally, the fall in joblessness and the high ratio of vacancies to unemployment should reinforce wage growth. But at a minimum, all these dynamics reinforce the need to eliminate slack smartly. Of course, what matters most for inflation is not wage growth per se, but pay relative to productivity. And stepping back, there's been little indication of the acceleration in unit costs that we had expected in the summer. And certainly, given the scale of foreign disinflationary pressures, current domestic cost growth is not yet consistent with a firming in underlying inflation rates. So that brings me to the final set of factors, core inflation measures. These measures strip out the direct impact of volatile items such as energy and food prices, and they help to give a read on how imported goods prices combine with domestic cost pressures to drive underlying inflation trends. They also give a sense of what headline inflation will be once the effects of those volatile items drop out of the annual comparison. Or put differently, total CPI inflation is more likely to move towards core inflation than the reverse, suggesting as a rule of thumb that inflation is likely to pick up but not overshoot core CPI in the year ahead. Those measures of core inflation have been below 2% since the middle of 2014, and they've been a bit weaker than we had projected in August. This mainly reflects weaker goods price inflation, which in turn, as I said, likely reflects past appreciation of sterling. Such dynamics will continue to weigh on core inflation for a while, since we estimate that around 2/3 of the inflation effects of a currency move will appear at horizons beyond 1 year, making those moves relevant for the monetary policy horizon. Of course, we're watching recent weakness in sterling closely because if it persists, it will moderate some of those effects. So let me conclude. What I've tried to do is describe the three factors that are guides to monetary policy decisions, in my view. But of course, they're guides. There are no magic thresholds. This is a journey without a set timetable, only an expected direction of travel. In my opinion, we need to see cumulative progress in these three areas in order to have reasonable confidence that inflation is on track to return to target and that a modest tightening of monetary policy will be necessary to ensure that it does so sustainably. That means sustained momentum relative to trend, domestic cost growth resuming a path consistent with headline inflation at 2%, and core inflation measures moving notably towards target. It's clear to me that since last summer, progress has been insufficient along these dimensions to warrant raising interest rates at this time. The world's weaker and UK growth has slowed. Due to the oil price collapse, inflation has fallen further and will likely remain very low for longer. This may mean modestly weaker cost growth through this year and the likely path for inflation, both headline and core, being softer as a result. In short, recent developments suggest that the firming of inflationary pressures we had expected will take a bit longer to materialize. Now, risk to the outlook and uncertainties about the economy are occupational hazards of monetary policymaking. The MPC's job is to assess them constantly and set policy accordingly. And in doing so, we do so without pre-commitments, beyond our unwavering focus on conducting policy in a manner consistent with our remit. That means we will do the right thing at the right time on rates. Make one final point, if I may. Doing the right thing requires taking into account a powerful set of forces, part secular, part cyclical, part domestic, part global. forces which have kept interest rates depressed throughout the recovery and into the expansion. These forces include demographic change, slower potential growth, higher credit spreads, lower relative price of capital, changes in income distribution, private deleveraging, and lower public investment. Given the likely persistence of these forces, our expectation is that the path for interest rates, the interest rates that balance demand and supply and keep inflation at target, those interest rates will recover only gradually and to a limited extent compared to the pre-crisis era. In other words, the journey to monetary policy normalization is still young. Thank you very much for your attention, and I'll be happy to answer questions.